Hey, good afternoon. We are live. This is Jeremiah Conger here with Annuity Association, tuning in on a beautiful Wednesday afternoon from bright and sunny Florida. And today we're going to be conducting another, you guessed it, unbiased annuity review. Today, we're going to be really diving into the specifics of the Allianz benefit control fixed indexed annuity. Before we get started, just want to share some levels of gratitude. It's been really amazing this year, 2021, for personally for myself and my firm. Just really want to say thank you to everybody that's been tuning in for these reviews, and the feedback that we've been receiving in regards to these reviews has just been very positive and very, very motivating for me. And I'm really thrilled and excited that, people are really getting a lot of value out of this when it comes to evaluating all of the various types of annuities on the market and ultimately determining whether or not they are right for them in their particular situation. And even more so, being able to provide a side-by-side comparison across the annuity marketplace to really make an educated decision on which one's going to help with your personal situation and help you ultimately meet your financial objectives. So I'm blessed to have this platform, blessed to have this opportunity, and just want to say thank you to all those that watch and give us a thumbs up on these platforms, and the people that just provide feedback that keeps us going with this stuff. So thank you. Before we get started with this review on the Allianz benefit control, I will start real quick with our brief disclaimer. So if you can bear with me, I'm going to go ahead and share my screen, and we will get that fun stuff out of the way. Bear with me. Okay, so let's start from the beginning here, and we'll get started. So again, we're talking about the Allianz benefit control fixed indexed annuity. This is an independent review brought to you by AnnuityAssociation.com. This is a review, not a recommendation to buy or sell an annuity. Allianz has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective in breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. Okay, so we've gotten that fun stuff out of the way, and we're going to go ahead and delve right in here on this beautiful review for the Allianz benefit control fixed indexed annuity. So again, I'm going to share my screen. Hopefully you can see it just fine. If there is any issues seeing it, or you need to enlarge your screen, you can click the bottom right-hand corner of your viewing window, and that should fix that for you. Okay, so let me close this thing out, pull this one up, get this one out of here. Okay, I think we're ready to share this. Let's go. Okay, here we are. Okay, so for those that aren't familiar with myself, my name is Jeremiah Conger. I'm an independent annuity advisor. I specialize in all types of fixed annuities, whether that be for income or safe growth. And I work with clients in all 50 states. So if you like what you hear in this review, or maybe you're looking to speak with me directly to understand this annuity a little bit more in depth, you can do that and schedule a meeting with me virtually by going to our website at AnnuityAssociation.com. Right there on the main page, click the green button to request your free report, and you'll be taken to a series of opt-in questions. One of those being, would you like to speak with an advisor? Simply answer yes, and I will personally reach out to you in a timely fashion to see how I can help. So if you're watching this review, chances are that you're entering a new phase of your life, and that is what we here call retirement. And retirement is the next great phase of life. the start of a new adventure full of promise, and most people spend their entire adult lives diligently working and saving for this moment. I'm sure many have already imagined what their future might look like, but whatever the goal, one thing is very apparent: retirement has changed, and so has the role of preparing for it. A greater responsibility has been placed on Americans to save for their future, and with this greater responsibility may come some uncertainty. It's natural to be concerned about saving enough for retirement, but it's important to have an income strategy for retirement too. Today, I'm going to introduce an interesting fixed indexed annuity and income rider combination that can help address both of these concerns. Thank you, by the way, for joining me today. Okay. So before I end my presentation today, it's important to note that any financial product is only as strong as the company behind it. And as a leading provider of retirement solutions, Allianz Life Insurance Company of North America has the strength and stability to remain true to its promises. Allianz serves over 3.7 million contract owners of products that include fixed and variable annuities and universal life insurance. Founded in 1896, Allianz provides innovative financial solutions for wealth accumulation, predictable retirement income, and protection of assets. High ratings from independent rating agencies reflect Allianz's stability, integrity, and strong balance sheet. For a history of Allianz financial ratings, you can visit www.allianzlife.com. The AM Best rating of A+, which is a superior rating, is the second highest of 16 possible ratings and was affirmed in September of 2020. The Standard & Poor's rating of AA, which equates to a very strong rating, is the third highest of 21 possible ratings and was affirmed August of 2020. And then Moody's, of course, has given Allianz a rating of A1, and that is the fifth highest of 21 possible ratings and was affirmed in October of 2020. In the end, contract owners want a company that they can design a reliable product and provide the stability behind them to last throughout their retirement lifetime. So Allianz Life Insurance Company of North America is part of a global financial powerhouse. Their parent company, Allianz SE, serves over 85 million customers in 70 countries and is the world's 46th largest company, fifth largest asset manager, third largest company in the diversified insurance industry based on assets, and fourth largest company in diversified insurance industry based on market value. Allianz in North America includes Allianz Global Investors and Pimco. Pimco is one of the world's leading fixed income managers. So here's a historical look at the top 5 companies in terms of fixed indexed annuity sales from 1997 to 2007. You'll see here that Allianz becomes the fixed indexed annuity leader in year 2000. And we'll take a moment here to just really review this. I think it's a big, bold statement just by looking at this chart to see how long Allianz has really been a leader in the fixed indexed annuity space. Okay. And then here's a historical look at the top 5 companies in terms of fixed indexed annuity sales from 2008 to 2020. Allianz was the fixed indexed annuity leader 19 of the last 21 years, while some other companies came and went. So this really speaks true to the consistency and reliability of Allianz and their innovation of fixed indexed annuity products. All right, so today's presentation, we're going to be really covering the following topics. The first is the Allianz Benefit Control Overview, or we'll be delving into the specific features and benefits and understanding the mechanics of this fixed indexed annuity. We'll also be talking about some key benefits while saving for retirement, key benefits while taking income through guaranteed lifetime withdrawals, and last but not least, opening this up for any potential questions that some folks may have. And if you have a question, obviously just post them to whatever media outlet you're watching this video on, and we'll be happy to help you with that. So let's begin looking at the benefits of the Allianz Benefit Control Fixed Indexed Annuity. As you prepare for retirement, you want control over how you create sources of guaranteed income. The Allianz Benefit Control Annuity, or what's referred to as ABC Annuity, is a fixed indexed annuity that allows you to activate lifetime withdrawals anytime through its lifetime withdrawal benefit rider included with no additional fee. The Allianz Benefit Control Annuity offers you a choice between different interest bonus options, which means every time interest is earned, it will be credited with an interest bonus. And with the cost of living in retirement potentially increasing due to such things as healthcare, inflation, and taxes, the Allianz Benefit Control Annuity offers the potential for increasing income based on earned interest as well as the income multiplier benefit, which can double the client's withdrawal if they become ill. And there will be some qualifications that apply for that income multiplier benefit. Okay. Fixed indexed annuities, or what are commonly referred to as FIAs, can offer many benefits to you, such as accumulation potential. This is the potential to earn interest based on changes in an external index. Allianz FIAs give you a choice of several indexes or indices, some exclusive index options, as well as a fixed interest option. Tax-deferred growth. You will not pay taxes on the interest the annuity earns until you take a withdrawal. This will help compound earned interest so the money in the contract can accumulate faster. Level of protection. The contract can earn interest based on an external index, but you are not actually buying any securities or shares of an index. This means the money in the fixed indexed annuity, which is referred to as the principal, is not at risk due to market losses. However, the principal may decrease due to charges like rider charges. Retirement income. Annuities obviously are designed to provide a reliable stream of retirement income, either for a set period or for as long as you live. Select Allianz fixed indexed annuities even offer the potential for increasing income in other riders, either built in or available at an additional cost to help you address specific needs. Fixed indexed annuities also provide death benefits for your loved ones, which can be paid out in a variety of ways. So let's cover some of these product details here on the Allianz Benefit Control. The issue ages for the Allianz Benefit Control are 0 to 80 years old. The minimum premium to start the contract is $20,000, and that can be either qualified or non-qualified funds. 10% of the total premium paid annually is allowed in a free withdrawal. The free withdrawal is available after the contract anniversary following the most recent premium payment, and you are allowed to add premium for the first 18 months. Select index allocations will have an allocation charge, and if the contract owner's marital status changes, the new eligible person can be changed prior to income election. The protected income value, which is the value of payments your income payments will be based on, is credited with a premium bonus after the contract is issued. For current rates, you can visit Allianz's rate page by logging into allianzlife.com. If withdrawals exceed the free withdrawal provision, they will be subject to withdrawal charge and market value adjustments during the withdrawal charge period, and the withdrawal charge period on the Allianz Benefit Control is 10 years. The Allianz Benefit Control has a built-in guaranteed lifetime withdrawal benefit, which is included at no additional cost, and the client will have the option of 2 different protected income value interest bonus options. The first one being what's referred to as the balanced interest bonus, or accelerated interest bonus being the second one. For current rates, again, we can see the rate page at allianzlife.com. The death benefit during the accumulation phase will be the greatest of the accumulation value, guaranteed minimum value, or cumulative withdrawal amount if taken in a lump sum, or the lesser of the protected income value at death, or 250% of the accumulation value if paid out over a minimum of 5 years. We'll be looking at an example of this at the end of the presentation. All right, so here we are with the key benefits while saving for retirement. Let's begin by looking at these additional benefits offered in the Allianz Benefit Control and what they can actually do for you. There are 2 bonus to help grow the protected income value. a premium bonus which will be applied immediately to the protected income value and to all premium paid into the contract. And the interest rate bonus will be applied at the end of each crediting period. Also, you will see the protected income value bonus you choose will also determine the accumulation value interest factor for your contract as well. There'll be more to come on that here momentarily. The protected income value is the value in the contract on which lifetime withdrawals will be based. This value is not available as a lump sum, and beneficiaries have access to this value if it's paid as a death benefit over a minimum of 5 years. Now let's talk about the first of two bonuses available with the Allianz Benefit Control Annuity. First, to help accumulate for retirement, all premiums paid in the first 18 months will receive an 18% premium bonus credited to the protected income value. In this example, we are assuming that the contract owner made a total of 3 premium payments in the first 18 months. Each crediting period, the contract owner will have the option to choose between the balanced or accelerated interest bonus option. The accelerated protected income value interest bonus option credits 250% of earned interest to the protected income value and 50% to the account value, or what's referred to as the accumulation value. The client can choose the bonus option at the time of application and can change it on any subsequent contract anniversary. However, 100% has to be allocated to either the balanced or accelerated option per crediting period. The balanced protected income value interest bonus option credits 150% of earned interest to the protected income value and 100% of the credit to the accumulation value. Rates are set at issue and guaranteed for the life of the contract. Please note, only the balanced protected income value interest bonus option is available once income withdrawals have started. Next, we'll look at an example of this bonus at work. So in this hypothetical example, the contract owner has started the contract with $100,000 and has allocated 100% to the balanced protected income value interest bonus option. The protected income value will receive an 18% bonus, making it $118,000 immediately. At the end of the first crediting period, the index interest is 4%, and the accumulation value will receive 100% of the 4% indexed interest, and the protected income value will receive 150% of the indexed interest, equaling 6%. The total values at the end of the crediting period will equal $103,050 in the accumulation value and $125,080 in the protected income value. In our accelerated option, the accumulation value and protected income value start off the same as the balanced. The indexed interest is 4% at the end of the crediting period. However, with the accelerated option, the accumulation value interest factor is 50%, and the protected income value interest bonus is 250%. The index credit will then equal 2% in the accumulation value and 10% in the protected income value. The new values will equal $101,050 and $129,800 respectively. Let's look at a case study now of a hypothetical IRA versus the Allianz Benefit Control Annuity. In this example, I'll show you that the Allianz Benefit Control has the opportunity to help lessen the stress on your portfolio, requiring only 1.5% return versus 8.5% return to generate the same income. Note that the fixed indexed annuity earning potential is limited by caps, spreads, and par rates. In this case study, a 65-year-old needs to generate $6,000 of annual income per year starting 5 years from now. They start with $100,000 for the ABC annuity, and they receive a premium bonus of $18,000. The next item we're going to look at is the return that needs to be generated by the investment in order to set up the $6,000 income. For an IRA, an 8.5% annual return would be needed. With the Allianz Benefit Control Annuity, the indexes being tracked would need a 1% annual return after caps, spreads, and par rates are applied. With the 250% accelerated protected income value interest bonus, this return becomes 2.5%. After the 5-year wait, the income value in the IRA would be $150,366. The Allianz Benefit Control Annuity protected income value would be $133,506. A typical withdrawal amount for an IRA is 4%. And with the Allianz Benefit Control Annuity, the lifetime withdrawal amount at age 70 after the 5-year wait is 4.5%. These factors bring our total income generated in the IRA to $6,015. And the total income generated in the Allianz Benefit Control is $6,008. Remember that to generate similar income amounts, an IRA would need an average of 8.5% return from its investments, while the Allianz Benefit Control Annuity can do it with a 1% return. Keep in mind that the assets within the IRA may provide more liquidity for emergency needs, whereas the annuity values will be subject to surrender and market value adjustment charges. All right. So let's look at key benefits while receiving lifetime withdrawals. When clients start lifetime withdrawals, there is the opportunity for the payment to increase every year or crediting period that interest is earned. And once that payment goes up, the increase is guaranteed. As you can see in this hypothetical example, the payment increases in years 5, 6, 9, and 10. In this hypothetical example illustrating the balanced option, which is the only option during the income phase, you see the starting withdrawal is $10,000. Remember, you can turn on any month. You can turn on the income on any month. At the end of year 6, the indexed interest is equal to 3%. However, your withdrawal will increase by 4.5% with the 150% interest bonus applied. You'll see here in year 7, being a down year, so the client's withdrawal stays the same. And at the end of year 8, the index interest was 5%, so your withdrawal increased by 7.5%. And year 9, the interest was 4%. When multiplied by the 150% multiplier, it increases it to 6%. As you can see, the withdrawals always have the potential to increase, but will never decrease due to market volatility. And the Allianz Income Multiplier benefit is the second way to help alleviate some of the rising costs during retirement. This benefit allows clients to double their payment by qualifying one of 2 ways. If the contract owner is confined to a qualified nursing home, long-term care facility, hospital, or assisted living facility for at least 90 days in a consecutive 120-day period, starting after the first year, or if the client is unable to perform 2 of 6 activities of daily living for 90 consecutive days, they would qualify. In our hypothetical example here, the withdrawal prior to the illness is $20,000. After meeting the criteria, the payment doubles to $40,000. As you can see, it still has the opportunity to increase due to indexed interest being credited to the contract. This benefit continues until either the client recovers or the accumulation value reaches 0, upon which the payments revert back to the standard payout. Please note, a physician must certify the covered person is unable to perform, without direct physical assistance of another person, at least 2 of 6 activities of daily living for at least 90 continuous days. In this next section, we'll discuss some important details and answer important questions. This slide puts all of the choices together. The Allianz Benefit Control offers 9 different indexed interest options and 4 different crediting methods, plus the fixed interest allocation. All totaled, there are 18 different indexed interest allocations, plus the fixed interest allocation from which to choose. And as we've said in the previous slide, these allocations can be changed each contract year or crediting period for 2-year point-to-point allocations, as long as they request for change as long as the request for change is received within 21 days after the contract owner's contract anniversary or crediting period. And if the request is received more than 21 days after their contract anniversary or 2-year anniversary, when choosing the 2-year point-to-point, it won't take effect until the following contract year or 2-year crediting period. The index lock feature gives you the flexibility to track and view index values online and initiate index value locks on select indexed interest allocations anytime during the crediting period. This can help minimize the effects of midterm market volatility while also providing the opportunity for positive index credits. The index value used to determine interest credited may be higher or lower than the index value at the time of request. This is a unique feature offered by Allianz. And there are 2 ways to activate an index lock. The first way is automatically with our auto lock feature. Simply set the index interest rate percentage you wish to target, and you can set both the upper and lower targets as long as you set them above, upper, or below, lower than the current index interest rate percentage. If your allocation options index interest rate percentage reaches the target, auto lock will automatically lock in the index value until the end of the crediting period. You are also free to adjust the target index interest rate percentage either up or down as many times as you wish, as long as auto lock hasn't been activated. And during that crediting period, and your upper target is greater or lower target is less than the current index interest rate percentage. And it's easy to administer. Just log into your contract online to set or reset your auto lock feature. The second way to activate index lock is a manual index lock. If a lock has not already taken place, simply request a manual lock anytime within the crediting period. Both options make it easier for your clients to receive a positive index credit in a volatile market, and both options can easily be done within their secure website. Index lock is available on select index allocations. The allocation charge applies to certain index allocations. The annual charge can range from a minimum of 0% to a maximum of 2.5%. The allocation charge allows Allianz to better manage investment risk in extremely challenging economic environments. Including this charge can pass that value on to you through more attractive product features such as bonuses and increased withdrawal percentages. We intend to change the allocation percentage only when one or more of the specific criteria are met. If the average of the daily 10-year US Treasury rates over a calendar year drop below 50 basis points, corporate bond downgrades are greater than 25%, and investment grade corporate bond defaults are greater than 50 basis points. We also maintain the discretion to not change the allocation charge, even if one of these criteria is met. The allocation charge is deducted annually from the portion of the contract's accumulation value and guaranteed minimum value allocated to the index allocation. It is based and calculated off the accumulation value at beginning of crediting period and deducted at the end of the crediting period after any interest is applied. The charge does not impact the contract's protected income value, which is the value on which lifetime withdrawal income is based. And there are 2 options for receiving the death benefit. You have the accumulated value or guaranteed minimum value or cumulative withdrawal amount if greater in a lump sum, or the protected income value if taken over at least 5 years. The protected income value death benefit equals the lesser of the protected income value at death, or 250%, which is the death benefit cap of the accumulation value. Let's look at 2 different hypothetical examples. In our first example, the client passes and $100,000 is available in the accumulation value and $225,000 in the protected income value. The death benefit cap would not come into play since the protected income value death benefit is less than 250% of the accumulation value. In our second example, the accumulation value at death is $100,000 and the protected income value is $300,000. In this scenario, the 250% cap would come into play. If you multiply the 250% by the $100,000 in the accumulation value to equal the protected income value death benefit of $250,000. The beneficiary can receive the $100,000 in the accumulation value in a lump sum, or take the $250,000 in the protected income value over at least 5 years. The cap can change on new business. However, once a contract is issued, the values cannot change. And if the client is admitted into an eligible nursing home, long-term care facility, or hospital and confined for at least 30 out of 35 days after the first contract year, they can take an accelerated distribution of the accumulation value as annuity payments over at least 5 years. There is no fee for this rider. The flexible withdrawal rider is an optional benefit that must be selected at issue. It allows withdrawal of up to the full contract value if the owner is confined to an eligible facility, such as a hospital, nursing home, or assisted living facility, for 30 out of 35 consecutive days. There is a monthly charge of 0.008333% of the accumulation value for this rider. So in summary, as we stated to begin with, the Allianz Benefit Control, or ABC annuity, is a fixed indexed annuity that allows you to activate lifetime withdrawals anytime through its lifetime withdrawal benefit rider included at no additional fee. And to help increase the benefit base faster, the Allianz Benefit Control annuity offers you a choice between 2 different interest bonus options, which means every time interest is earned, it will be credited with an interest bonus. And with the cost of living in retirement potentially increasing due to such things as healthcare, inflation, and taxes, the Allianz Benefit Control offers the potential for increasing income based on earned interest, as well as the income multiplier benefit, which can double the client's withdrawal if they become ill. There are qualifications that will apply for that benefit. So is the Allianz Benefit Control annuity right for you? If you're looking for an annuity that can provide an opportunity for indexed interest when the index is up and protection when the index is down, and you're looking for income payments that can increase, Allianz Benefit Control with the protected income rider may be right for you. As a financial professional, I can help you decide whether Allianz Benefit Control fixed indexed annuity may be a good fit for your overall retirement strategy. And if you'd like to work with me directly, I work with clients in all 50 states. You can schedule a meeting by visiting my website at annuityassociation.com. Right there on the main page, you can click the button to schedule your free consultation using our secure portal, which is Zoom. Okay, and we're just going to show these quick disclosures regarding some of the literature here and the terms and conditions and trademarks of the various indices and index strategies that are offered in the Allianz Benefit Control. And then momentarily, we're going to go ahead and take a look a little bit further into the specific index crediting strategies that are available. We're only going to look at a couple of them today, but we're going to look at some of the more popular ones that are offered in the Allianz Benefit Control so that we can get an understanding of how they work and what some of the hypothetical performances may have been over some periods of time historically. So bear with me, I'm going to get that pulled up. I appreciate you being here with me today. Just a moment, we will take a look at these. All right, here we go. Okay, so here we go. I'm going to share my screen now. Hopefully you can see this pretty good. All right. So again, if you need to enlarge your screen, please feel free. There should be a button or icon at the bottom right-hand corner of your viewing window to make this larger for you. So first and foremost, we're going to be taking a deeper dive into some of these specific index crediting strategies and indices that are offered in the Allianz Benefit Control. The first one being the Bloomberg US Dynamic Balance 2 Excess Return Index. This is a volatility-controlled allocation designed to help stabilize renewal rates. A closer look at the Bloomberg US Dynamic Balance 2 ER index allocation options within the Allianz benefit control. So as you approach retirement, you may need a retirement strategy to help protect a portion of your assets from market volatility. Allianz Benefit Control Annuity offers traditional fixed indexed annuity benefits such as tax deferral, guarantee of principal against market downturns, and the opportunity to earn credited interest. While Allianz Life Insurance Company of North America offers a unique selection of index options to choose from, let's take a closer look at one particular index that may help you combat market volatility. This is the Bloomberg US Dynamic Balance 2 Excess Return Index. So for an index overview, the Bloomberg US Dynamic Balance 2 ER Index is comprised of the Bloomberg US Equity Custom Futures Excess Return Index and the Bloomberg Barclays US Aggregate Custom RBI Unfunded Index, and shifts weighting between them daily based on historical realized volatility. The Bloomberg US Equity Custom Futures Excess Return Index is a custom index that tracks futures on large cap equities, similar to futures on the S&P 500 index. The Bloomberg Barclays US Aggregate Custom RBI Unfunded Index is a custom index designed to track future prices on the Bloomberg Barclays US Aggregate Bond Index, a well-established benchmark for the US bond markets. Every day, the Bloomberg US Dynamic Balance 2 ER Index dynamically allocates between the Bloomberg US Equity Custom Futures ER Index and the Bloomberg Barclays US Aggregate Custom RBI Unfunded Index based on their historical realized volatility, a measure of the magnitude of daily movements regardless of direction of an index. In general, when the Bloomberg US Equity Custom Futures ER Index volatility is low, the balance shifts more towards the Bloomberg US Equity Custom Futures ER Index. And vice versa, when volatility is high, the balance shifts towards the Bloomberg Barclays US Aggregate Custom RBI Unfunded Index. If volatility is high in both the equity and bond component, the index may control volatility by decreasing the index weights so that they add up to less than 100%. The balancing of risk every day helps stabilize index performance over time. The Bloomberg US Dynamic Balance 2 ER Index uses an excess return methodology by tracking the price of futures. Futures prices reflect the expected future price of an index and account for expected dividends. Excess return indexes are designed to bring a level of stability to renewals for the associated crediting method from year to year by reducing the effects of changing short-term interest rates. So when it comes to index mechanics, realized volatility is calculated for the Bloomberg US Equity Custom Futures Excess Return Index and the Bloomberg Barclays US Aggregate Custom RBI Unfunded Index over 20 days and 40 days. For the Bloomberg US Equity Custom Futures Excess Return Index, the greater of the 20 or 40-day realized volatility is used to determine the weighting, and realized volatility for the Bloomberg Barclays US Aggregate Custom RBI Unfunded Index is calculated based on historical daily returns over the corresponding period of 20 or 40 days. These realized volatilities are used to determine the final weight allocation daily. And that weighting allocation can change up to 5% daily. And so let's look at and talk about hypothetical historical depictions. So this index was launched on August 9th of 2018, and all information presented prior to this launch date is hypothetical, or what we refer to as backtested. And backtested performance is not actual performance. The backtested performance is based on the methodology and mechanics of the index retroactively applied to historical market data as if the index has previously existed to generate hypothetical performance during the periods of time depicted. This backtested performance for any constituent that makes up the index may have actual performance and history, and it will also have backtested data for any period prior to its inception. Backtested performance may not be a reliable indicator of future results, and prospective application of the methodology and mechanics of the index may not result in performance commensurate with the backtested returns shown. In an effort to help the index achieve the target volatility, The index was changed as of April 21st of 2020, so that the index weights may not add up to 100% in times of extreme volatility. Therefore, any historical depictions, including index weights and hypothetical returns, will not include this change for data prior to 4/21 of 2020. And for the hypothetical historical weighting, here is a hypothetical chart showing how the last 16 years of weighting between the two underlying indexes would have looked had the Bloomberg US Dynamic Balance 2 excess return index existed. Again, this index came into existence on August 9th of 2018. So the 16-year period shown reflects the longest common period of historical data available for each of the indexes that comprise the Bloomberg US Dynamic Balance 2 ER index. So this is a hypothetical chart, and it's provided to show how the indexes would have been balanced during the period shown. It is no guarantee of return or future performance. So you'll see the purple shade, the dark purple shade there is the Bloomberg US Equity Custom Futures ER Index, and the lighter purple shade is the Bloomberg Barclays US Aggregate Custom RBI Unfunded Index. So let's see how the Bloomberg US Dynamic Balance 2 ER Index would have looked relative to its components over the last 16 years. Showing the index comparison doesn't necessarily indicate how much interest would have been credited to a fixed index annuity over that time. Actual contract results would depend on crediting method chosen and participation rates in place during that time period. Past results are not a guarantee of future results. And so here for the index returns from 2005 to 2021, again, looking at this in hypothetical backtested nature, you'll see the purple line representing the Bloomberg US Equity Custom Futures ER Index, the dark gray line being the Bloomberg Barclays US Aggregate Custom RBI Unfunded Index, and that darker greenish blue color representing the actual Bloomberg US Dynamic Balance 2 ER Index in this hypothetical backtested nature. So you'll see that the lines, when you look at the individual indexes themselves, the purple shade and the gray shade, you'll see that on this chart, the volatility is pretty high in comparison to the greenish blue shade. So the design of the Bloomberg US Dynamic Balance 2 ER Index, again, is, as we've mentioned, to smooth out levels of volatility to ultimately provide more consistent returns over time. One of the examples here, if you look at that chart going into March of 2020, and you'll see the significant drop in that dark purple line. And you'll notice that the dark grayish green blue line representing this Bloomberg US Dynamic Balance 2 ER Index, that decline in March of 2020 is significantly lower than the actual purple line. And that is an indicator of the volatility being controlled and managed. So how could Bloomberg US Dynamic Balance 2 ER Index have worked within the Allianz Benefit Control Annuity? The Bloomberg US Dynamic Balance 2 ER Index allocation is available on the Allianz Benefit Control Annuity with either an annual point-to-point crediting method with a participation rate or a 2-year point-to-point with a participation rate. It's totally up to you. It resets at the end of the crediting period, which provides you with the opportunity to receive interest when the index rises. The chart to the right highlights the last 16 years of hypothetical historical returns in the Bloomberg US Dynamic Balance 2 ER Index and the interest that Allianz would have credited after applying a participation rate. It assumes the Allianz Benefit Control was issued on January 1st of 2005 and was available during this time period, which it was not. The Bloomberg US Dynamic Balance 2 Excess Return Index return reflects hypothetical historical data from December 31st of 2004 to December 31st of 2020 using the current participation rates. Remember, this chart represents past hypothetical results only. Actual participation rates that could have been applied over this time frame would have been different from the figures in this example, and in some cases may have been dramatically higher or lower depending on a number of factors. Actual results will vary depending on market conditions, index allocation choice, and participation rates. No single crediting method consistently delivers the most interest under all market conditions. Although an external index may affect your interest credited, the contract does not directly participate in any equity or fixed income investments. You are not buying shares in the index. So here we'll start looking at this chart here, starting with contract year 2005. And you'll see the first column being the hypothetical historical Bloomberg US Dynamic Balance 2 Excess Return Index. And then the second column being the annual point-to-point strategy allocation indexed interest at 55% participation rate, followed by the next column, which is the 2-year point-to-point allocation indexed interest at an 80% participation rate. And so you'll see as the hypothetical back-tested performances unfold in each year, you'll see the actual, what hypothetically or potentially could have been credited if these participation rates and strategies were available during this time. In an index scenario with a flat or negative result, the lowest possible index interest rate is 0%, and this is not intended to project or predict future results. And to learn more about the Bloomberg US Dynamic Balance 2 ER index allocation and the Allianz benefit control annuity that has this allocation, please feel free to contact me directly by going to annuityassociation.com. Right there on the main page, you can click the button, the red button, to schedule your free virtual online consultation, and I would be happy to have that opportunity. Okay, so that is the Bloomberg. Next, we have the Pimco. Let me make sure that you guys can see this at home. So let me reshare my screen here. There we go. Okay, so the Pimco Tactical Balanced Excess Return Index is an adaptive allocation designed to help stabilize rate renewals. And here's a closer look at the Pimco Tactical Balanced Excess Return Index allocation with Allianz benefit control annuity. As you approach retirement, you may need a retirement strategy to help protect a portion of your assets from market volatility. Allianz benefit control offers traditional fixed indexed annuity benefits such as tax deferral principal protection from market downturns and the opportunity to earn credited interest. While Allianz Life Insurance Company of North America offers a unique selection of index options to choose from, let's take a closer look at one particular index that may help you combat market volatility, and this is the Pimco Tactical Balanced Excess Return Index. The Pimco Tactical Balanced Excess Return Index is comprised of the U.S. Equity Futures Custom Index, a bond component comprised of the Pimco Synthetic Bond Excess Return Index with a duration overlay, and shifts weighting between them daily based on historical realized volatility of the components. The U.S. Equity Futures Custom Index is a custom index that tracks futures on large cap equities, similar to futures on the S&P 500 index. And the Pimco Synthetic Bond Excess Return Index is a custom index comprised of a smaller number of instruments designed to provide exposure to futures on U.S. investment grade and treasury bond markets. The duration overlay adjusts the interest rate exposure in response to changes in market trends. And every day, the Pimco Tactical Balance Excess Return Index dynamically allocates between the equity component and the bond component based on historical realized volatility, which is a measure of the magnitude of daily movements regardless the direction of an index. In general, when the U.S. Equity Futures Custom Index volatility is low, the balance shifts more towards the U.S. Equity Futures Custom Index and vice versa. When the U.S. Equity Futures Custom Index volatility is high, the balance shifts towards the bond component. And if the volatility is high in both the U.S. Equity Futures Custom Index and the bond component, the index weights may not add up to 100% in an effort to achieve its targeted volatility. This balancing of risk every day seeks to stabilize index performance over time. The Pimco Tactical Balance Excess Return Index uses an excess return methodology by tracking the price of futures. Futures prices reflect the expected future price of an index and account for expected dividends. Excess return indexes are designed to bring a level of stability to renewals and for the associated crediting method from year to year by reducing the effects of changing short-term interest rates. So here's a chart showing the tactical allocation during different volatility regimes. When volatility is low, you'll see that more of the allocation is towards the dark purple shade, which is the equity exposure with the US Equity Futures Custom Index. Levels of medium volatility, you'll see that dark purple shade becomes more balanced, with the lighter shade showing an equal weight in the bond component, which is the Pimco synthetic bond excess return index with an overlay. And then you'll see in levels of high volatility, a smaller exposure, reduced exposure in the dark purple equity component, but with more exposure in the bond component. And then with extremely high levels of volatility, you'll see the overall balance and allocation is less, with only a small portion of it being exposed to the bond component, which again is the Pimco synthetic bond ER index with the duration overlay. So this index was launched on August 2nd of 2018, and all information presented prior to this launch date is hypothetical, or what we refer to as backtested. And backtested performance is not actual performance. The backtested performance is based on the methodology and mechanics of the index retroactively applied to historical market data, as if the index had previously existed, to generate hypothetical performance during the periods of time depicted. This backtested performance for any constituent that makes up the index may have actual performance in history, and it will also have backtested data for any period prior to its inception. Backtested performance may not be a reliable indicator of future results, and prospective application of the methodology and mechanics of the index may not result in performance commensurate with the backtested returns shown. So the 16-year chart below shows the hypothetical weighting between asset classes had the Pimco Tactical Balanced Excess Return Index existed, which it did not. The index came into existence on August 2nd of 2018, and as you can see, in periods like 2008, when market volatility was high, the index would have shifted heavily to the bond component, and at times, the component weights would have not added up to 100%. So when it comes to interest rate exposure, the Pimco Tactical Balance Excess Return Index also adjusts the sensitivity to interest rates based on underlying trends in bond markets. This feature can potentially benefit the bond component during the different interest rate trends. It is a common misperception that bonds are a risk-free investment. This is simply not true. One of the risks bonds are subject to is interest rate risk, and in general, falling interest rates mean rising bond prices, and rising interest rate means falling bond prices. Duration is a common indicator of a bond's price sensitivity to these interest rate fluctuations. A larger duration number indicates more interest rate risk is present. So here you can see in this example the reaction to underlying market trends. When the bond prices are down, and that means interest rates are up, or vice versa. And that means that we need to decrease interest rate exposure toward the minimum or the duration. And conversely, on the other side, if bond prices are up and interest rates are down, we can look to increase interest rate exposure toward normal. The Pimco Tactical Balance Excess Return Index reacts to changes in the short-term and long-term averages of interest rates to potentially help address the risk of rising rates. If the 5-day average of interest rates is higher in relationship to the 40-day average, the index will generally adjust to lower the duration of the underlying bond portfolio, and the relationship between the 5-day average and the 40-day average could be a leading indicator of a trend in the interest rate environment. On the other hand, if the 5-day average of interest rates is lower in comparison to the 40-day average, the index would generally adjust back toward the target duration for the index. So how could Pimco Tactical Balance Excess Return Index have worked within the Allianz Benefit Control Annuity? The Pimco Tactical Balance Excess Return Index allocation is available on Allianz Benefit Control Annuity with either an annual point-to-point crediting method with a participation rate, or a 2-year point-to-point with a participation rate. It's up to you. It resets at the end of the crediting period, which provides you with the opportunity to receive interest when the index rises. The following chart highlights the last 16 years of hypothetical historical returns of the Pimco Tactical Balance Excess Return Index and the interest that Allianz would have credited after the participation rates were applied. This historical chart is intended to show how the index and crediting method could have worked together had the index and product been available during the time periods shown. This is assuming the Allianz benefit control was issued on January 1st of 2005 and was available during this time period, and assumes the current participation rates. The Pimco Tactical Balanced ER Index return reflects hypothetical historical data from December 31st of 2004 to December 31st of 2020. And the 16-year period shown reflects the longest common period of historical data available for the components that make up the Pimco Tactical Balance Excess Return Index. Remember, this chart represents past hypothetical results only. Actual participation rates that could have been applied over this time frame would have been different from the figures shown in this example, and in some cases significantly higher or lower, depending on a number of factors, including market conditions. No single crediting method consistently delivers the most interest under all market conditions. Although an external index may affect your interest credited, the contract does not directly participate in any equity or fixed income investments, and you are not buying shares in an index. So here with the chart to the right, you'll see the various contract years starting with 2005. And then we're going to have 3 columns, starting with the first one, which is the hypothetical historical Pimco Tactical Balanced Excess Return Index performance. And then the second column showing the annual point-to-point allocation indexed at a 55% participation rate. And then a 2-year point-to-point allocation indexed interest at 80% participation rate. And so when you start to compare these returns here side by side, once the participation rates are applied, you'll see the actual potential hypothetical interest rates that would have been applied if we owned this product during this time frame, which it was not available. But this is just showing you an example of how this potentially would have worked during this time. So you'll see in 2005, being a negative year for the Pimco Tactical Balanced Excess Return Index, because of the guarantees of principal protection and 0% floor, if you had an annual point-to-point allocation with the 55% par rate, you would have just simply gotten credited a 0%. But if you look at the 2-year column, because of it being a 2-year crediting period, it's actually taking both years 2005 and 2006 and blending those together to get an average multiplied by the 80% participation rate, and the net interest credit hypothetically would have been 2.3% in that 2-year period. Moving to 2007, you'll see 2.95% for the balanced Pimco Tactical Balance ER Index in the hypothetical example. The annual point-to-point with the 55% par rate would have provided a 1.62% hypothetical interest return. And then the 2-year at an 80% par would have provided 7.19% when factoring in both 2007 and 2008. Going to 2009, 4.21% on the Pimco Tactical Balanced ER Index in the hypothetical example, with the 1-year participation at a 55% participation rate, 2.32%. And then in the 2-year with the 80% participation, 12.8% when factoring in both the 2009 performance and 2010. So this gives you a really great idea of how these, hypothetically when it comes to back testing, how these index strategies would have potentially worked when applying today's participation rates. And remember, these interest credits are the first part of the formula when it comes to factoring in your protected income value, whether you have the balanced allocation protected income value strategy or the accelerated you would apply those multipliers, whether it be 150% for the balanced or 250% for the accelerated. You would take these interest credit figures, multiply them by those multipliers, and that would equate to your growth on your protected income value. To learn more about the Pimco Tactical Balanced Excess Return Index and the Allianz Benefit Control, you can contact me directly by visiting our website at annuityassociation.com. Right there on the main page, you can click the red button to schedule your virtual meeting with me right on my calendar, and I would sincerely appreciate that opportunity. Okay, so now, while we are in the final stretch of our Allianz Benefit Control annuity, the last step will be for us to take a look at an example illustration, to take a look at it specifically to understand the mechanics on the ledger and kind of break down what's occurring, since we've now understood, what is, what the components are. I think it's good to put them all together on an illustration to see, how it unfolds. So if you'll just bear with me, I'm going to go ahead and get that pulled up, and we'll get started with that here in just a brief moment. Thanks again for watching. If you've gotten some value out of this content, please do us a favor and click the like button or give us a thumbs up. We would greatly appreciate that. It will help this video get ranked and hopefully help people that are looking for similar information find this video for them to use as a reference. Okay, so I'm almost finished here. Just putting this illustration together. Okay, so let me go ahead and get this pulled up. The first part of the illustration that we're going to start with, once I can get this shared here, will be the guaranteed values of the Allianz Benefit Control. Okay, now this illustration will be available in the description of this video below. There will be a link that you can access this illustration so that you can view it at your own discretion. So first and foremost, the example that we're looking at is a 60-year-old male located in the state of Florida who is looking to put a $100,000 premium into the Allianz Benefit Control fixed indexed annuity. This is the guaranteed values portion of the illustration. All annuity illustrations will have a form of guaranteed values. This is the guaranteed portion for the Allianz Benefit Control. And so what we're looking at is how the Allianz Benefit Control annuity might look over a 30-year period. The values show what would happen if the indexed allocations earn 0 indexed interest and the fixed allocation earns the minimum annual fixed rate at 10 basis points in all years. The guaranteed accumulation value reflects the maximum allocation charge as shown on your illustration assumptions. And after the initial guarantee period, an allocation charge can only be increased if one of the following criteria is met in one of the 2 preceding calendar years. The average US 10-year Treasury rate for the calendar year is less than 50 basis points. Corporate bond downgrades for the calendar year are greater than 25%, and investment grade corporate bond defaults for the calendar year are greater than 50 basis points. Okay, so we'll see the contract years to the left, the age of this individual in this hypothetical example is age 60 starting out, and then you'll see the third column from the left being the premium column, and we have $100,000 going into the Allianz Benefit Control. Now, as we mentioned, this is the guaranteed values portion of the illustration, so it's assuming that 0% interest credit has been accrued. So you'll see every year for the columns stating end of year indexed interest rate, end of year credited interest rate is 0 in every single year on this illustration, all the way showing up to 30 years or age 90 for this example. You'll see end of year accumulation value showing us the 100,000 going down or being reduced to $97,500. This is reflecting the rider charge that is on this particular index crediting strategy, which we chose the 2-year point-to-point Bloomberg Dynamic 2 balanced ER index. We put 50% of the monies there and 50% of the monies in the Pimco Tactical Balanced ER index. Both of those index strategies involve a allocation charge to ultimately help us get a higher growth potential for the specific index strategies. So that rider charge is 95 basis points. And you'll see that the end of year accumulation value is going down, reflective of that rider charge as well. Now, we'll move on over to the protected income value. You'll see that we're still getting the 18% premium bonus that's being applied over to the protected income value. So that 100,000 multiplied by the 18% bonus is growing the protected income value to 118,000. And in this example, you'll see that that 118,000 stays the same because, again, no interest credits are being applied in this example. So I did, in this example, elect to have the lifetime income stream, the guaranteed lifetime income stream or guaranteed lifetime withdrawal benefit rider. We had that elected to turn on in contract year 7 when this individual is turning age 67. And you'll see that the guaranteed lifetime withdrawal amount and this guaranteed values of the index illustration, is $4,720. Okay. And to understand the values shown, you can always refer to the defined terms found within the Understanding Your Contract Value section of this illustration. And you'll also see here that values are shown are not guaranteed unless specified as guaranteed values. Rates and annuity payout rates are subject to change, and actual values may be higher or lower than the hypothetical values shown. This illustration is not valid without all 18 pages and the statement of understanding. All right, so let's go on up to the hypothetical values next. So what is occurring here is the most recent 10-year calendar year period. Here's how the Allianz benefit control annuity might look over a 30-year period. And the values show what would happen if the indexed allocations earned indexed interest using current rates in all years. The indexed interest is based on actual index performance during the most recent 10-year calendar period for the first 10 years. In all later years, the same 10-year period is repeated, where they repeat the index performance from the first 10-year calendar period. And so you'll see here again in this example, the contract years to the left, the male age 60 putting $100,000 in premium into the Allianz benefit control fixed indexed annuity. And we'll see because of the 2-year crediting periods that we elected for our allocations in the index crediting strategies, you'll see now in this example, in the first contract year, we have 0% interest credits because, again, it's a 2-year crediting period, meaning that interest will not be applied until the end of the second year upon anniversary. So we'll see here in contract year 2, the end of year indexed interest rate was 9.35%, and the end of year credited interest rate was 4.68% to the accumulation value. Remember, we have this set up for the accelerated benefit. So 50% of that indexed interest rate credit goes over to the accumulation value. In this case, that's 4.68%, increasing the end of year accumulation value to $102,731. You'll see the end of year pre-market value adjustment cash value, which is reflecting the surrender charges if you surrendered your contract earlier than the fulfilling 10 years. end of year guaranteed minimum value at 87,349. And then here's where that accelerated multiplier comes into the protected income value account. The protected income value interest credit is 23.38%. And what they're doing is, again, taking that 9.35%, multiplying it by the 250% multiplier offered when electing to have the accelerated protected income value rider. And we'll see that because of that large credit coming in, the protected income value grows to $145,583. Again, in the third year, 0% interest credits because it's the first year of a 2-year crediting period. We'll see the end of year accumulation value at 101,755, and then the protected income value still at 145,583. In year 4, because it's the end of that second crediting period, and the interest crediting strategies having a positive performance for that crediting period of 9.97%, we'll see that the interest credit end of year credited interest rate going towards the accumulation value is 4.97%, increasing the end of year accumulation value to $105,839. And then we'll see over at the protected income value interest credit, again, the 250% multiplier applying to that 9.97% end of year indexed interest rate, creating a 24.92% protected income value interest credit, increasing the protected income value to $181,867. You'll see that this same example again, going into year 5, it being the first year of another 2-year crediting period, 0% across the board on those interest credits because it doesn't credit till the end of the second year. The accumulation value end of year at 104,834 to reflect the allocation charge. And then protected income value staying at 181,867. Finally, in year 6, the end of another 2-year crediting period, we have end of year indexed interest rate of 2.74%. 1.37% is being credited over to the accumulation value because that's 50% of that 2.74. And then we have a protected income value interest credit once the 250% multiplier has been applied to that same 2.74% figure. The protected income value increasing to 194,303. Again, electing to have the income stream turned on from the guaranteed lifetime withdrawal benefit. And now we see the lifetime withdrawal starting at $7,772 in contract year 7. Now, here's what's interesting is as you see these interest credits coming into play and them being applied over to the end of year accumulation value, as well as over to the protected income value, we're going to start to see some things change here. Remember that once income is turned on, the accelerated benefit now changes or reverts to or defaults to the balanced structure. So the balanced protected income value rules take over. And we'll see that when an interest credit comes in, that after that second year of income being turned on, we'll see that 10.46% of the end of year indexed interest rate comes in. End of year credited interest rate comes over here at 10.43%. Therefore, creating a small lift and the end of year accumulation value at $96,967. Now, what's occurring is once income is turned on, that becomes a debit, if you will, against the accumulation value. So you're going to, when you receive this distribution of $7,772, that will reduce the accumulation value dollar for dollar. Now, because interest has been applied, you'll see here that there was a small increase, of a few $100s up to, what, $500, a little less than $500, $480 to be exact. And then you'll see the protected income value actually had a bump because, again, the balanced allocation protected income value rules apply. And you'll see that 10.46% interest credit, when applying the 150% multiplier that's provided in the balanced protected income value rider, that the interest credit being applied towards the protected income value is 15.7%, increasing the protected income value to $191,433. You'll notice that because of that interest credit coming in, starting in that contract year 9 column, the income has now received an increase from $7,772 to $8,988. And that increase is a direct reflection of that protected income value going up. Okay. So you'll see that this continues on. Again, they're repeating the first 10 years, showing you hypothetically in nature how the increasing income could potentially work, and also showing how the end of year accumulation value, once income's turned on, that it has the potential or likelihood to continue to reduce and eventually go to zero. Okay, so you'll see in this example that the accumulation value goes to zero in contract year 18. But because we still have that income stream and those income, once that income amount is achieved, it's locked in and it continues on. And you'll see that we also still have the potential for increasing income based on the index performances coming in and being applied directly to the income value or the lifetime withdrawal amounts to provide potential for increases. Again, to understand these values in more detail, the values that are shown, you can always refer to the defined terms found within the Understanding Your Contract Value section of this illustration, or you can see the guaranteed values ledger for the guaranteed values. Okay. So a couple key things to note here before we conclude this review. And again, I just want to make sure I'm showing us, what this illustration was comprised of. Again, a male age 60, $100,000 premium structured with single lifetime withdrawals, income starting in year 7. Now, we will see here some literature talking to the potentials of increasing income. And Allianz does state that of contracts where the increasing income option was chosen, 95% have received at least one increase. And that percentage of clients taking income who have received at least one increase, the total number of contracts used for this analysis was 22,648. And represents any increase of any amount in a given year. Income payments were elected from January 1st of 2008 through December 31st of 2018. And income increases are reflective of multiple products and income benefits that were available at that time. Individual contracts may have seen varying amounts of income increases. This supplemental illustration must be accompanied by the full product illustration. Refer to the illustration ledger of guaranteed values within the full product illustration for guaranteed elements and other important information. Okay, so I believe that's going to go ahead and wrap up our review of the Allianz benefit control. I know this has been a long one, so I want to say thank you if you're still here. Thanks for watching. I really do appreciate it. Hopefully that you've gotten some value out of this review that can ultimately help you make an educated and confident decision on whether or not this is the right product for you and your financial future. Again, if you're interested in working with me directly, I work with clients in all 50 states. I would be honored for that opportunity. To schedule a meeting with me, you can visit our website at annuityassociation.com. Right there on the main page, click the red button to schedule your free online virtual meeting using Zoom. And you'll be taken to my calendar, and you can schedule a date and time that is convenient for you. And I'd be, again, honored to have that opportunity. So thanks so much for watching. We hope you've gotten some value. If you have, give us a like or thumbs up, or please share this video with your friends and family that may find some value in this as well. It would be greatly appreciated. This is Jeremiah Conjure with Annuity Association signing off. Hope you have a great rest of your day. Take care of one another. So long.